At the start of this year, US stocks were overvalued and overpriced, and there was considerable optimism, almost euphoria amongst investors. The US economy was booming, incomes of the rich were growing very fast, AI was the new wonder technology which would transform the economy, and then the Trump administration were promising tax cuts and deregulation. It was a giddy time for investors. Who remembers 2008? Seems like a distant memory. Even that business of asset-backed securities, which crashed the economy in 2008, is back with a vengeance. A record $335 billion of asset-backed debt was sold last year. And this is before all the new forms of financial speculation, meme coins, leveraged assets, crypto and derivatives. Even house prices seem to become a one-way bet once again. And whilst many ordinary Americans have been squeezed by stagnant real wages, living paycheck to paycheck, the top 10% have $1.3 trillion of excess savings. No wonder money has been flooding into the stock market. But January 2025 might well prove to be the moment of peak US stocks. Markets are waking up to the threats of tariff wars, global instability, slowing house sales, deportations, federal spending cuts, and a ballooning budget deficit. The Nasdaq has fallen 4%, Bitcoin is down 20%. Sentiment is starting to shift. According to Atlanta Fed's real-time GDP data, the start of the year unexpectedly showed a fall in GDP, in theory the start of a recession. Also this year, house sales have fallen to record levels, below even COVID times. The trade war looks to be heating up, and consumer sentiment has been reduced by rising prices and cuts to federal spending. And the stakes are high because to get the stock market valuation to return from current 37 times earnings to a more normal Shiller P/E ratio of around 18 times would require a drop of 50%. So can US exceptionalism in stock markets still be justified? Well, firstly, the fall in GDP looks dramatic, but it is also slightly misleading. What is happening is that there's been a big surge in imports. US business are trying to get ahead of tariffs. They've been importing in bulk to avoid any future tariffs. And when imports increase, it means spending money leaves the economy, and this leads to a lower GDP. But it does highlight the fact that business are taking the trade war seriously, even if markets are just hoping it will kind of just blow over and not have much effect. Proposed tariffs could lead to a real global shock. It would hurt the ability of firms to make profit. And whilst there is considerable uncertainty about how much tariffs will rise and what kind of tariffs, this uncertainty itself is actually a problem, with many firms starting to put investment decisions on hold. The best estimates about what tariffs may look like would suggest they would be substantially higher than in previous years. And despite some improvements in inflation in recent months, American consumers are starting to show elevated expectations of future inflation. And this is largely because fears of tariffs raising prices have filtered through. It's also not helped by things like rising egg prices, psychologically quite important. Now, it is worth bearing in mind that the past era of free trade of the past 3 decades may have had its problems, but it has been very profitable for transnational companies. A tariff war could really hit their bottom lines. They've been very profitable in recent years, and that's one reason for the stock boom. But tariffs isn't the only threat the US economy faces. The housing market is often a reliable guide to future economic downturns. And this year we've seen a sharp fall in house sales to record low levels, even lower than in COVID times. And when housing sales fall, this historically has predicted an economic downturn and rising unemployment. The housing market is a little strange because despite higher interest rates in the past couple of years, house prices never fell. They've been squeezed higher by a shortage of supply, but also 30-year fixed-rate mortgages, which have insulated many homes from rising interest rates. But the record house price to earning ratio means that many households are struggling to buy, so the market has become very stagnant. People can't move because they can't afford to remortgage, but many first-time buyers can't afford to get on the property ladder either. And US home builders are increasingly pessimistic. Falling sales is not their only problem. The threat of mass deportations, which often relies on undocumented workers, would hit construction hard. It would also hit the food industry and meat processing industry. Also, tariffs on timber from Canada would increase construction costs. In the last housing market index, sales expectations for the next 6 months dropped 13 points to 46. Now, in recent years, the US economy has become heavily dependent on spending from the top 10%. The top 10% now account for 50% of all spending in America. 30 years ago, that was just 36%. In fact, the top 10% account for 87% of stocks, 84% of private business, and 67% of total wealth. Now, during the last year, high earners increased their spending by 12%, whilst the working and middle classes actually reduced their spending. So the US economy is increasingly two-tier. The high GDP growth really reflects the good fortunes of those top earners and wealthy. But a stock market shock would adversely affect this top 10% with a lot of money invested. And it's hard to have a very persistently strong economy when there's this disparity between the poor and the rich. Now, the big question is, do US stocks justify their exceptional price-to-earnings ratio? Now, it's not as high as a Japanese stock bubble in the late 80s, but it is still pretty high compared to historical trends. A lot of the high earnings is due to the assumption that artificial intelligence implies unusually high returns in the future from this new technology. But this is starting to be questioned. The sudden arrival of DeepSeek from China challenges the US model on huge levels of investment in AI. This is a story yet to unfold. Also, the new Trump administration is proposing radical spending cuts to Medicaid and other items of the federal budget, federal workers, SNAP food programs. The loss of Medicaid for low-income households will be another economic squeeze which reduces their spending power. But ironically, in the last quarter of 2024, it was actually government and healthcare spending which contributed more than half to US growth. Federal cuts of around $2 trillion would have a deflationary impact on the economy. Although the other side of the coin is that in the next budget, proposed tax cuts of $4.5 trillion have been lined up, and this will increase the already large US budget deficit. Now, it would provide an economic stimulus, but perhaps not as much as last time, because this is largely an extension of past tax cuts, so it may not affect spending that much. Also, it may be the case that finding $2 trillion of spending cuts is actually much harder to achieve in reality than just talking about it. Talking about cutting wasteful, fraudulent spending has been a recurring theme for the past few decades. But in reality, it is actually hard to find $2 trillion of spending cuts without impacting people's lives and having political costs. It would be hard to find $2 trillion down the proverbial back of a couch. The non-partisan Committee for Responsible Federal Budget state that the recent budget resolutions would add at least $2.8 trillion to the deficit by 2034. And also cutting things like science spending, federal investment in different areas of the economy like education, could start to affect the long term of the US economy. If you cut back on scientific investment, then one of the US's great strengths may be slowly eroded over time. Going back to the budget, betting markets state that the chance of a US government shutdown in 2025 are now running at 55%, i.e. more likely than not. And this reflects the ambitious scale of tax cuts against a backdrop of rising budget deficits. And any slowdown in economic growth will put even more pressure on that budget deficit and debt interest payments. Even before the upcoming tax cuts, long-term spending commitments are set to soar. Tax cuts on top of this will cause an even bigger budget deficit. Already federal spending on interest payments are running at over $1 trillion, and this is expected to rise to $1.8 trillion by 2035. Now, given the likelihood of soaring US debt, does this matter? How will the government respond? Well, there has been some talk of forcing investors holding US Treasuries, that's short-term debt, to exchange them for 100-year bonds, which is effectively a form of default. And if this was actually implemented, it would send shockwaves through the global financial system. US Treasuries are currently seen as one of the safest assets in the world, and if this was to come under threat, financial flows to the US would look very different. It would be a huge shock. Now, restructuring US debt via some kind of Mar-a-Lago agreement may sound like that kind of fanciful idea that will never materialise. But the global perception of the US as a safe and stable environment for business may be increasingly challenged over the next few years. But what is perhaps more likely is not restructuring debt, but a new form of quantitative easing, the US Treasury creating more money to fund the deficit. US stock markets started the year overvalued by many metrics. Overvalued compared to earnings, overvalued compared to the rest of the world. This was based on the fact US growth much faster than other countries, and people were very bullish about US tech stocks. But compared to a few months ago, there are more reasons to expect a market correction, if not some kind of crash. There's greater uncertainty over housing, tariffs, federal spending, budget deficit, general economic policy. Of course, anything is possible, and it's worth bearing in mind the US economy still does have many strengths. Its strong growth is not unmerited. It's got many good companies, high productivity, and strong levels of investment in the private sector in recent years. But it does also now face new threats. And in particular, it's worth understanding why speculation has increased so much in recent years, because this adds another layer of risk to the system that has not been fully quantified. This video goes into more detail. So thanks for watching, and do subscribe. We'll have more great videos coming soon. Who knows, maybe with a bit of good news to come as well.